Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. For 3 years now, we've been sharing the latest market data every week in our weekly Altos Research video series. With the Top of Mind podcast, we are looking to add some context to the discussion about what's happening in the market from leaders in the industry. Altos Research tracks every home for sale in the country every week, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People desperately need to know what's happening in the housing market right now. The market was frozen so solid last fall, and now surprisingly, the landscape is changing. So if you need to communicate about this market to your clients, your buyers and sellers, go to altosresearch.com and just book a free consult with our team. We'll review your local market and how you can use market data in your business with your buyers and sellers. Okay, let's get to the show. I have a terrific guest today, Gary Beasley. Gary is the CEO, co-founder of Roofstock, whose platform lets everyone from first-time investors to global asset managers evaluate, purchase, and own residential investment properties. Gary is a true pioneer in real estate technology, and he's one of the few people who has a longer history in this industry than I do. Gary's track record
older than you, Mike.
The track record, though, includes both Zip Realty and Starwood Waypoint through IPOs to the IPOs. Gary also served as CEO of Joie de Vivre Hospitality, the second largest boutique hotel management company in the country. Gary was named top 50 FinTech CEO and has been named to Housing Wire's HW Vanguard. So Gary, welcome to the show.
Good to be here, Mike.
I really appreciate the time today. And, this is great because we talk about the market, we talk about, where things are going in the market, and Roofstock as an investment platform has a really unique position. So I'm interested in hearing, a lot about Roofstock and what you see through it. But before we dive into all of the Roofstock things, I mentioned a little bit of the tenure in real estate technology. Tell me about that journey. Let's start there.
Yeah, well, Mike, I don't know if you remember the first time we met, but I think it was about 20 years ago when I was at Zip Realty and you were in our offices.
It might, yes. It might have been
when about that a few minutes ago as we were getting on this call. But so we were both early looking at housing.
Super early.
And so I guess I would just say that I've spent a lot of my career at the intersection of technology and real estate. And I've had a focus on operationally intensive real estate, hospitality, single family rentals, where it's a kind of a combination of a real estate investment and an operating business. And because I think you can apply technology to a lot of those models and get some real leverage. And it's also areas where innovation can really pay off. So I like to innovate. As Mike mentioned, I was early in the single family rental space. So with some friends and I, we started buying homes during the downturn, the prior downturn, the great financial crisis in about 2008, 2009. We started buying homes with our own money, friends and family money. We raised some funds and eventually some institutional capital, formed Waypoint Homes. We were, I believe, the first platform to get to 1,000 rental homes that we owned and managed. And that was in January. I remember it because it was in January of 2012. It was in the Wall Street Journal. This company's got 1,000 homes. And then by the end of that quarter, Invitation Homes, which was Blackstone, was buying 1,000 homes a week. That was the beginning of the institutionalization. It took us, 3 or 4 years to get to that 1,000 that we scraped together. And then it was, so those were really interesting times. And if you look, Mike's a data guy, prices declined for 5 years. And in the first quarter of 2012 is when home prices started to tick up again. And that was really when all the institutional capital started to flow in and effectively provided a floor. It did provide a floor for the housing market. And then it was, off to the races from there. And so we built a REIT. We took several thousand of these homes and put it in a vehicle, went public, and I was running that as a CEO of that business, and then left about 2015 to form Roofstock with the idea that, wow, this industry is going to continue to mature. We could talk about some of the characteristics of it if you're interested, but it's a massive industry, and didn't really have infrastructure for investors to buy, sell, and manage more efficiently. So that's what we built. I like to describe Roofstock really as kind of like we're providing real estate investment as a service for investors. So you can plug into us just like AWS or Amazon webs, or any other cloud service, Salesforce. Rent our platform and put money to work, and we'll help you buy, sell, or manage. And then when you're done, you can unplug and no harm, no foul. But it's a way that we could offer the best sort of tools, technology, data, team insights to investors out there who don't need to necessarily be experts on their own or build their own infrastructure. You sort of rent ours. And so that's the basic business model. We've been around for about 8 years now. We've done close to $6 billion of transactions, I guess, through the platform since we started. We manage about 17,000 houses for investors. So we're pretty active in the space, and we see a lot of the trends going on. And Mike, I'm a regular fan of your podcast and your regular broadcasts on the market, and it's very interesting because I try to listen to a lot of these and triangulate around them and to see what trends are. And so it's always useful. Although we're focused on the investor side, we're still in housing, and so all the trends that are affecting the owner-occupied trades are very relevant to what investors are seeing, and vice versa. So
yeah, man, so many things to dive into there. One of the things that you mentioned, so I didn't realize at the time. I remember Waypoint starting and building. Waypoint was one of the few that was buying homes before the turn was obvious. In the Altos data, so the housing market bottom, the conventional date is January of 2012. In the Altos data, we could see a turn in the first quarter of 2011. And it was with our leading indicators, in that we could start to see the data turn there. And one of the things that, and maybe we'll put a pin in this for later in the conversation, but one of the things I'm interested in is how investors can be counter-cyclical, and because I watch so much of the money be pro-cyclical. We watch the iBuyers who were buying right up until the prices were, the demand fell out, and then they stopped, and they haven't started yet again. Even so, I see.
It takes a lot of conviction to be counter-cyclical, or a lot of people like to say they're contrarian. They're only contrarian when there are other people being contrarian, and then they're following those contrarians. So it's really hard to be a thought leader. And I remember in the early days, we were buying these homes in the kind of Far East Bay, Pittsburgh, Antioch, Vallejo, places like that, that back in the peak were, say, $400,000, and we were buying them for about $125,000.
Whoa!
We were putting in 25 grand. And we were getting a 10% net yield. And we were saying, what's wrong with this? What's wrong with this picture? The only thing we could find wrong with it was we weren't buying enough houses. I mean, that was literally it. We were like, are we crazy? Or is everyone else not seeing the obvious? Because we said, we know we're buying houses that will recover at some point. They're generating incredible cash yields. By the way, no one can buy a house anymore, so everyone's renting. So we had waiting lists for these houses to rent. No one had the capital to renovate them and make them livable. So we're buying all these homes and making them nice. The neighbors loved us. It was this virtuous cycle, right? And there was no financing available. There was no debt financing. It had to be on a house by house or full recourse basis. Their banks wouldn't lend more than 50% on those rental homes at $125,000 or $150,000 value, when they were lending 97% when they were worth $400,000. That's how crazy it was, right? And so, we just knew that was a good trade. We didn't know if we could create a company out of it, but we thought it's possible. And if we could figure out how to manage these at scale, we applied a lot of technology and business process automation, things like that back then for the underwriting and the management. And we were able to make a platform out of it. And we were one of the early folks to kind of scale a scattered site management operation. Then it was just for our own account. Since then, a lot of companies have done that. And now we're sort of doing the same thing at Roofstock. We've kind of rebuilt on newer technology, but we're offering it for third parties to use it instead of just, for our own account.
Yeah, that's quite a journey, and wow, what a bunch of learnings in there. And I think it was not at all clear that you could do single family management at scale in a diverse environment compared to a concentrated real estate, a concentrated apartment complex. And so that was a risk you took.
It was a risk we took. And I can't tell you how many times at conferences in the early days, people just thought we were crazy. There's no way you could manage these things efficiently. No way. And it was the apartment folks in particular who couldn't get their heads around. It's hard enough to manage an apartment building. But there are actually some advantages to the scattered site, I think, as you know, but you don't have any common area expenses like you have in apartments, which is kind of a nice thing. So you don't have pools and utilities and things like that you have to maintain and pay for. That's kind of a big deal. And then your turnover is about half as much as in apartments. So it costs you a little bit more when someone moves out, but it's a stickier resident.
Yeah.
They tend to stay 3 or 4 years. And when you work through all those, the math, it turns out that the operating margins are quite similar to apartments.
That's great. Before we move off of your history and into the future, let's talk about Zip Realty first, just a quick sec. So Zip was the original internet-based real estate brokerage.
Yes.
And I can imagine the pitch deck at the time, that was, as I like to say, 2 bubbles ago, right?
Yeah.
And maybe now we call it 3 bubbles ago. What did you learn at Zip that you've brought forward?
Yeah, so I learned at Zip that first of all, people craved information and data, and so we were really, I think, the first to put complete MLS data online. And there was a lot of controversy about that and how it should be done. The National Association of Realtors didn't like it very much and tried to.
And this was like 1998.
Yeah,
right?
late 90s. There's a whole bunch of stuff that's happened around that. We do a whole show on that. But at the end of the day, we were allowed to do it. We sort of were pioneers in what's called the virtual office website construct. So the idea that someone should be able to sit on their computer and see a listing as opposed to being handed a cut sheet in someone's office. And it was, it's impossible for people who didn't live through that to think that was actually the case, but it used to be the case. Yeah. Information then creates, when people have more information, they have more power. So we empowered consumers. We had a discount commission structure. We actually had a rebate to the buy side. We rebated a portion of our commission to our buyer clients. People liked the service. The website was awesome. We had a similar issue with Redfin, though, and then a lot of people use Redfin's website, but they don't use their agents. It just happens to be a phenomenal search tool, and then they'll use their neighbor to represent them, and they say, "Thank you very much." We had a lot of that happened, but that was okay. We were building a brand. We had over 2,000 agents when I left. We were profitable. We were public. As you mentioned, we took the company public. We're purchased by Realogy. Ultimately, so it kind of got subsumed by Realogy. The brand sort of went away, and they used some of the technology, but it ceased to exist as a standalone brokerage. But I learned, there's a lot of information out there on the resi side that wasn't put to use, and certainly we weren't empowering. We're starting to empower people with that, and that's powerful. I also learned it's kind of hard to reform an industry from within as opposed to coming at it with a totally different model. Because we were participating in the real estate space with a discount commission structure that people frankly didn't love. because people kind of like their commissions the way they are. Thank you very much. And as opposed to at Roofstock, what we've done is we really sort of created our own marketplace. So so we've sort of, how do we bring buyers and sellers together directly? How do we work with investors to build their own portfolios? And we do work with agents and brokers all over the place, but we had to come at it with a very fresh mindset of how to build a business that wasn't necessarily just looking through the mold of an existing construct and then tweak it around the edges. It was really, let's start with a whiteboard and say, okay, if we're going to build sort of a customer-focused, customer-centric model for investors, how would we build it? And that's where we started.
That is great, and so that's a great segue to talking a little bit more about Roofstock. So Roofstock is a marketplace. You have sellers and buyers, and marketplaces are awesome when they work. They're notoriously hard to jumpstart.
Yeah.
Like to seed, you need you can't have the ghost town. You get buyers in there, but there's no sellers, and you can't have sellers with no demand. So what? Tell me about that. How did you jumpstart it?
Yeah, it's a great observation. I know I was at a conference early on, and somebody said, marketplaces are so valuable, but they're so hard to start, but they're even harder to kill once you actually get them going because you get those network effects. So we knew that I knew that I could get supply from a lot of the single family rental owners because there was no efficient way to sell houses with tenants in them back then. When we were selling homes from Waypoint from some of our early funds, the only way we could do it was to vacate it and sell it through the MLS. And there was a lot of leakage in terms of costs, not only for the commissions, but lost rent and CapEx to prepare it for MLS sale. It still worked because the properties had appreciated so much, but we thought, well, gee, wouldn't it be great if we could sell the home with a tenant in place for a couple %, not have to vacate it. You don't have to wait for the tenant to move out. You don't have all that friction. And we match, and we know there's buyers who would value the tenancy, whereas opposed to that tenant being a liability, the tenant was part of an asset, right? That was the very simple idea of Roofstock. So I went to all the CEOs of the different companies. I said, hey, I want to start this marketplace. I need you to give me 20 houses to sell, and I'm going to put them up and see if we can attract buyers. And that's how we got the first 100 listings. Because I said, listen, if it works, I'm going to be a great outlet for you to be able to get some liquidity without having to vacate the homes, and I'm going to be really cheap, and I'm going to have scale and drive it down. So selfishly, I said it's in your best interest. It's in my best interest too because I need supply. Then had to go build a website and a process for buying homes sight unseen. No one had ever sold $200,000 items online before that you don't see, right? Yeah. No one's ever heard of Roofstock. You're in Seattle. You're buying a home in Orlando through some site. How do you build trust? And so one of our investors in the very early days said, to build a marketplace, the first thing you need to do is build trust. So think about, this was Mark Benioff actually, think about what you can do to build trust. And we came up with this idea of a 30-day money back guarantee. So we did that. So you could buy a house, and if you didn't like it for any reason in 30 days, we would essentially give you your money back. We'd buy it back for what you paid, and then we would resell it, and we would keep any profit or loss based on that. It seemed kind of crazy, but very few people took us up on it. But once we did that, people said, okay. It's like when you buy that airplane ticket and it's cancelable, right? For 30 days, for a day. So we did that. We got the marketplace going. We started to build liquidity. What we realized was in the early days that marketplace was really interesting and useful, but we were leaving a lot on the table by it being one and done. So investors would buy a home through us, and then we'd pair them with a local property manager, and we were done with the relationship essentially. And what we realized was we wanted to stay connected to the clients long term. So we bought a property management company called Street Lane Homes, and we kind of upgraded all the tech, integrated it in with Roofstock. And so now we have a full stack model where we can own the property management going forward as well. So then we have an ongoing relationship with the owners. We could develop relationships with the residents in the homes. We collect all the data post sale, so we can monitor the performance, and that helps us with our underwriting engine. So there's a lot of reasons to build this full stack platform, and so that's why I think we've really migrated. I think you correctly noted that we really started as a marketplace, but we've sort of the model has sort of expanded, if you will, into this kind of full real estate as a service platform where the transactions are part of it. The buy side and the sell side transactions happen within this ecosystem, but we also have a big management business, both property and asset management, and a lot of data being analyzed that services all of these different sort of verticals.
Yeah. Okay. So before we get into the data, with the observation, the interesting observation is that, there have been a lot of people, and I know this because over the years they call me and they say, "Hey, I'm building an investor website where they can buy properties." And, there've been a lot of people with that vision, but very few of them had, it was like only Gary could do this because Gary came out of Waypoint and had actually had the ability to fill the supply as you go out the door.
It was a huge advantage, Mike. I mean, having those relationships helped, but I think as important, if not more, was understanding how the industry worked. And so when we were raising capital for the business, the fact that it's a huge addressable market is important and critical. The fact that we were an experienced founding team was really important and critical. But I would say the industry knowledge piece of how does this work, understanding investor pain points, looking at things through an investor lens, and then building tools to address what we knew were pain points was probably the most important part of getting our capital raised. And there's a lot of people who could build a great website and put together a great kind of PowerPoint deck, but to actually execute on it is hard. And if you come at something without any industry knowledge, the advantage is blank slate. You're not constrained by the way things are done. But I think that if you can know how things are done and still whiteboard it and say, I'm not constrained by the way things, but I know how they think. I know what the issues are. I understand the regulatory environment. I understand how what the constraints are. That's a huge enabler. And it really, I think some of the more successful founders have enough of that industry knowledge and enough of the ability to look beyond the way things are done and combine them together.
Yeah, that's a real skill to know the rules well enough to choose which ones you're going to break.
Yeah, that's right.
Yeah.
Well, yeah.
That's great. Okay, so you mentioned data and the data that you have and the data that you're learning. So let's talk about, let's talk about the unique view. What do you have on the real estate market, or maybe for investors, the returns? What does Roofstock know that the rest of the world doesn't or should know, or is maybe getting wrong?
Yeah, well, I don't know if there's an easy answer to that. As real estate is inherently local, and so it's hard to generalize about what's going on with the real estate market, which is one of the reasons I think your research is so useful, the way you go into different markets. But generally, I think we can see trends, kind of like you pointed out, Mike, that you did back in the 2011. Maybe a little bit earlier, because we see what's happening with investor activity. We see investor buy boxes, for example, and a buy box would be, we've got an investor who says, I want to buy a property of this kind of yield in this type of market. We see how investors are adjusting their buy boxes in real time, for example.
Okay, that's a great one. So,
Yeah.
so can you tell me a little bit about how that buy box changed last year, beginning in April last year, and what it's looking like now?
So I would say here, take a market like Phoenix is a good one because it's a lot of just a lot of activity in general. So it's a little bit of a nice sort of microcosm. If you go back to late 21, early 22, things are blowing and going. So kind of first quarter of 22, investors were buying, let's call it homes in Phoenix at $250,000 home in Phoenix at sort of a 4% capitalization rate. So that unlevered yield of 4%. They were able to borrow at 3% or less through warehouse lines or securitization. So there was meaningful, what we call positive leverage in that equation. As rates started to go up, investor appetite, especially investors who relied heavily on leverage, started to become more cautious, and they said, "Hey, you know what? I need say a 5.5 cap rate because rates are kind of coming up and cresting 5%, and I still would like to have accretive leverage." And so what they were saying is, instead of paying a price that would get me a 4% yield, they would say, "Well, I need to pay 20% less." However the math would work, and so what that did is it created, houses were they might have gone from 250 up to 300, and then all of a sudden they came back, and then rents continued to go up, and then prices started to come down, at least from with rates going up and investors needing a higher yield. So it actually brought prices down to where they were before, and in some cases a bit below. But rents have not necessarily come down. Rents have been stickier in a lot of those places. Now, there's more homes for rent now than there were, and we could talk about the implications of interest rates on renter demand, which I also think is interesting. It's also a positive, I think, for the single family space longer term. But we could see pretty early on what was happening as rates were ticking up and how cap rate expectations were going up, that was quickly going to turn into investors not being very active if rates continued to go up and Chairman Powell's vision was being, was working itself through. We knew at some point in 2022 things were going to grind to a halt, which they did. Now, Phoenix is a really interesting example, and again, things tend to happen a lot quicker today than they used to a decade ago. We're already seeing Phoenix sort of start to recover again. So, and I think you've probably seen it in some of your data, but depends on the neighborhood and the price point. But areas where there was very weak demand, we're now starting to see sort of some capitulation where sellers are selling. There's a shortage of inventory, which prevented prices from dropping very much. And then you have buyers who are somewhat fearful of rates going back up again, knowing they could always refinance, so they're pulling the trigger. And then you've got investor buyers who think, the price has gotten low enough to where over the long term, I still feel really good about the long-term growth prospects in this market. So the correction seems to be happening quicker, not multi-years like we saw back in the Great Recession, the Great Financial Crisis. It was like a 5-year correction where prices kind of went down. And one of the things that I think you point out, Mike, in some of your stuff, and I follow the home price data, it's deceiving because year over year, it seems like prices are coming down, right? Because you're looking 12 months ago. But if you look to the prior month, the last couple of months, they've been ticking up. So it depends on how you interpret the data, whether the home prices are going down or they're going up. They're going up month over month, down year over year against very difficult comps.
Yeah, exactly. And so the buy box now is so are investors saying, so that property went from 250 to 300 back to 250.
Yeah.
And are investors now saying, well, I can take a slightly worse cap rate on?
Yeah. So I would say it depends on the investor, but generally, if prices went down enough to say generate a 6% cap rate, then investors would buy everything. And still, like today, they buy everything. Yeah. But today you can't really buy much at a 6%, but it's also not at 5 either. It's kind of somewhere in between. And so if you see continued rent growth, even if prices stay flat, the yields go up the way the math works, right? So you're not very far from it starting to make sense. There are buyers who are starting to buy without leverage, so they're less sensitive to the mortgage rates. Insurance companies, for example, or family offices or high net worth investors who might pull money out of the stock market and say, you know what, I want to put a little bit more in property because I feel like it's stable. There's some tax advantages to having it in real estate versus the stock market. I'm worried about volatility in the stock market, and I'm just going to park it in some houses. So we're seeing more of that sort of stuff happening. And then at some point, when rates inevitably come down again, a lot of these investors will put debt on the property.
At that point, okay, and so we can see some of the demand in, say, Phoenix, which obviously recovered, and as you pointed out, put a floor on some of the prices. So the demand there would be likely less leverage dependent.
The high leverage money isn't super active there right now. So
Right.
so that's
Okay.
right. So
Yeah.
so I'd say there's fewer buyers in the market, less reliant on low cost leverage to justify their purchases. But there's also, not a lot of inventory either. So there's more inventory than there was a year ago, but a lot less than there was, in the past, right?
In the
So
past.
we're well
Yep, for
below
sure.
that. So, I would say there's homes that are appropriately priced are trading. There's enough demand for the limited supply, I think, for things to clear. The real challenge we have right now is with rates where they are, no one wants to give up their 3% mortgage to sell,
Yeah.
to move to for the benefit of taking on another 6 or 7% mortgage. So people are keeping those homes and renting them or whatever, and so that's keeping the supply to either forced sellers, really kind of forced sellers. But the discretionary sort of move up or move down buyer sees no incentive to do that right now, and so
Yeah.
and then the other supply issue is new construction, and we've got a shortage of homes in the United States, and depending on which analyst you talk to, it's a big number. A lot of the projects that have been planned are now on ice because in this interest rate environment, these projects are not happening, and so it's going to create, unfortunately, I think a shortage of supply over the medium to long term. We were just starting to catch up a little bit, and then now I think we're going to be behind again. For all those reasons, it's one of the reasons I'm fairly bullish on housing broadly and single family rental. Is there's a real, I think, floor on where prices can go just because of the supply constraints, and there are enough pockets of demand to support those prices, and I think over time increasing prices.
That is a great synopsis. So you're broadly bullish on the sector over the medium to longer term
Yeah.
because of our structural shortage problems.
Yes.
That's a great. I appreciate that insight. Let's talk about your users, your clients. As a real estate investor, how do I look at the market now, thinking about risks and opportunities, and what should I be thinking about?
Yeah. So one thing about real estate is very hard, like with anything, it's very hard to call a bottom. And so I think that, I encourage people to think about their time horizon. If they're looking to do a quick flip, I think it gets a little bit more challenging because it really matters when prices go up again. If you're looking to have a longer term strategy of building a portfolio for some income or some ultimately appreciation and wealth creation, then I think buying through cycles, kind of like the whole dollar cost averaging approach in stocks, kind of makes sense to me. Yes, prices could go down, kind of like what I mentioned we did at Waypoint. We started buying in 2009 and prices still continue to go down for another couple years. We're like, that's okay. It was cheap then. Yeah, it's cheaper now, but I still have a house that long term a good value when I think
Yeah.
about where the fair value is. So I guess I would encourage people to think about it more as a longer term journey. There's much less competition now in terms of absolute number of buyers. With the big institutional players not active right now, I think it's a good opportunity for others to buy, and not as if, and it's not as if the big institutional guys are buying everything, because it still is a very small piece of the overall bucket. But if you have fewer people out there buying because interest rates are higher, and you're willing to stomach it, then I think it's interesting. I think one interesting strategy is to either, just buy and then say I'm going to refinance in a couple of years, and that's good. You can also buy down your mortgage, pay a few points up front and get a lower interest rate, and that's what some people are doing today. So you could buy your mortgage down into the fours, you pay some money up front, you're like, okay, and I'm just using that as a negotiating ploy with my seller, and I'm just getting that, I'm asking for this discount off the list price, and if you could get to this price, I'll buy it, and then you're locked in at a more reasonable mortgage rate. So there's ways to skin it. I think sometimes people get too scared by where rates are. I think people are now, I think, starting to become more active and say, yeah, rates aren't going to, I don't love a 6.5% rate or whatever, but probably not going to be there forever. And if I could get the house, then I'm looking at the delta between that and where my refi is going to be. And I'm just factoring that into my bid strategy. And I'm not, by the way, I don't have to bid 15 or 20% over asking price either. Now I'm bidding a little bit below asking price, and maybe I could catch a motivated seller.
Yeah. Okay. I love those strategies. That's really a great way to look at it. And it seems to me like the smart investors know these options that they have, but maybe some novices and maybe some big institutional money are what's taken off the margins of the competition, and the people who are left in the middle are the operators, the long-term operators, and it's
Yep,
probably healthy for the market, I
I
suppose.
think so. Yeah.
Are you seeing any of the big, and I don't know if you could talk about this directly, but are you seeing any of the big institutional guys who've built up these massive portfolios over the years? Are they saying, you know what, we want to get, any of them saying we want to get out before it crashes, or like, are you seeing any kind of thing like that from any of those?
No,
Any signal?
honestly, not a single one. We know them all, and
Yep.
they have a lot of conviction long term about it. Now, one, in fairness, that's their business and that's their strategy. So they could, in theory, say I'm going to liquidate all these houses and get out, but not a single one of them believes that would be the right strategy. Think they're not all buying very aggressively. Some of them are starting to buy on the margins, or at least make offers. But long term, they're all very constructive about it. And what I am seeing is more and more new capital monitoring the space, interested in figuring out how to get into it at the right time. Like,
And
because
that's
they
new capital, like this spring, or this like we
no,
watch.
this is new capital that might come in back half of this year or next year. So long-term capital that want to make sure that the market's settled enough that they're not going to sort of catch a falling knife, but loves the macro play with U.S. housing. And when you think about it, we look at all the challenges of housing, but when you look at it relative to pretty much every other asset class in real estate, it compares pretty favorably. It's the most liquid. There's the beauty of single family rental is you've got two ways you can sell it. You could sell it on a cap rate basis to an investor. You could sell it to an owner occupant. And so it's almost like an apartment that's mapped for condo, right? You
Uh-huh.
can rent it or you could sell it, right? So there's this built-in optionality. You look at the office sector, very challenged. A lot of people worry about retail because of online distribution, still very popular. Hotels are cyclical. It can be very good if you get at the right part of the cycle. But when multifamily could get overbuilt, it much more easily than single family rentals. It's a lot harder to build hundreds of thousands of houses than it is hundreds of thousands of units of apartments, and they're largely substitutes for each other. and those markets are quite distinct. You don't see a lot of overlap between apartment dwellers and single family rental renters. So you do see that there's been a lot of vertical development in apartments that's going to cause, I think, some softness there. So there's a lot to like about single family rentals, just from a macro level. And I think we're seeing that. And the other thing about it is it's the most accessible real estate asset class for individual investors as well. People can understand it. It's pretty straightforward. It's historically been kind of difficult to do because the financing's not easy and there's a lot of paperwork and it's kind of complicated, the management side. So that's where I think there's now service providers who can help with a lot of that stuff. There's a lot more data than there used to be. There's still not great financing options. We're sort of working on that. I was actually on the phone with someone from Fannie Mae earlier today, talking to them and encouraging them to lean in and start to offer more financing products for the middle market, which they don't do today. If you're a really big owner, you get really good financing. If you're an individual owner and you want to buy 1 to 10 homes, pretty good financing, Fannie and Freddie programs. If you want to own 10 to 1,000, pretty crappy. And there's a lot of people who would like to migrate, small business owners, if you will, who'd like to build portfolios beyond that 10 and have access to kind of more robust and attractive financing. And I think there's a really good story there to help build wealth amongst minorities and kind of parts of the population that historically have not had great housing access. I think there's a really interesting kind of virtuous circle that could be achieved there with some better financing in that could be an on-ramp for lots of folks there.
That is really encouraging. I always love the taking a step back from the like, hey, we're buying houses to get a better yield on this thing, to like, what are some positive impacts on society that this work has, and like some opportunities that are in front of us.
I tell you, absolutely. I mean, you've known me long enough, Mike. That's a big part of what I think about. But rental housing is an important part, I think, of the housing stock in the United States. Not everybody can afford to buy a house, at least not right now. And some people just like the flexibility of renting. And today, especially with today's interest rates, I think John Burns has done some research. It's something like $800 or $1,000 more to pay a mortgage on the same price home versus your rent. It used to be they were kind of at parity in a lot of places, and now with rates higher, it's a lot of people just priced out of buying. So one of the things I was talking to the folks at Fannie about is think about all those owners of those rental homes. Those are people, right? Only 3% of the 20 million single family rentals are owned by the big institutions. 97% are owned by smaller owners. So by enabling more people to be able to own those homes, you are promoting housing ownership. It's just they're owning homes that other people rent, and you're providing a product, an affordable product that people can live in and they need. And by doing all these things, we can improve the quality of the housing stock. We can provide a better service to them by promoting professional. One of the good things that all the big operators do is I think they generally do a very good job at the property management piece. They have brands to protect. They have technology to help be responsive. All those things. That's not universally the case with mom and pop landlords. They might self-manage. They may live somewhere else. So the more that we could promote the use of best practices and software and technology and things like that for that other 97%, I think the better experience there will be for others. The big operators follow fair housing, for example. That's not universally the case with every mom and pop landlord. It should be, right? So more and more of these things, if we can continue to take some of the best that we've learned from the institutions, and that's kind of like part of our mission at Roofstock is let's take that technology and let's make it open to a much broader array of people to get the best of breed technology and all that. Then I think that does sort of democratize access, and I think it is good for society.
That's terrific. So you painted a broadly bullish view on real estate investment, single family investment in particular, um, but one thing that strikes me is that we have a lot more investors and a lot more investment owned properties than we have had in the past, like in previous recession cycles. So, what are risks, or what happens that might change that view? What are things that you know what might we run into? Like, what happens in a big job loss recession? What kind of risks are we seeing? Are we facing?
Yeah. So it's interesting. There's some positives and negatives to investors. And I'll give you, like I mentioned one earlier, that investors put a floor on housing in 2012, which was really important. Who knows how far housing would have dropped before, became really cataclysmic. You have, I think, support right now on a yield basis, now that there are professional investors who I mentioned will buy a 6% yield in Phoenix all day long. Prices in the price points that investors like, which is, call it, 150,000 to 400,000, kind of that range, they can get that sort of yield. There's real downside protection on the home price. That provides a floor for everybody's value, which I think is generally a good thing. And I think that will help there be much less downside risk to the vast majority of owners those aren't rental properties, the owner occupied. Still 2/3 of the people own homes. It's interesting if you look at the stats, we're kind of at an 8-year high of home ownership percentage. We've talked about all of this, all these investors coming in and buying up the properties. We're sitting at about 66% home ownership today. It was 63%. You go back 7 or 8 years. So while all the investors have been coming in, amazingly, the owner occupied, the percentage of homes that are owned by homeowners has gone up. So they can sort of peacefully coexist. So I think in a big job loss recession, there are going to be more renters, right? If you can't service your mortgage, you need to sell your home. You may not be in a position to buy, so you may need to rent, or you may need to move to find a job, assuming that the people do go back into offices at some point, which I think is starting to happen. So, there's some kind of, I guess my point is there's some kind of offsetting influences there. If there's a big job loss recession, it'll put downward pressure on rents, and should put downward pressure on pricing, downward pressure on demand to some degree. So home price appreciation should definitely slow, and in some cases go down. But I don't see it. I could be wrong. I think it's very unlikely that there's going to be a massive correction in home prices. Now, if very different from, say, office, or commercial in general, where we have $1.5 trillion of commercial mortgages coming due in the next couple of years, and rates are going to be twice as much, and values are down. That's going to be a bloodbath. So I wouldn't want to be in that space. When you look at housing compared to that, it feels safer. Again, there's risk with any investment, and I personally like housing because of the fundamental supply-demand dynamic we talked about, and the fact that people need a place to live. It's very much kind of a utility, and not in a utility sense, but you see what I'm saying. Everyone needs a place to live, so the fundamental demand for a rental home goes way up in some of these downside scenarios. So during the great financial crisis, I've got a great slide that shows prices going down every year for 5 years, and rents not going down during that period. So really sticky. And the reason for that was there were a lot of people who needed to rent. And I think the same thing could happen here, where you might see some softness in demand of people able to buy, but you'd probably see a spike in demand. And I think you'd see houses still being full, and maybe rents coming down a little bit or being flattish for a while.
Those are great insights. By the way, when you that at that moment when you and your buddies say, "Hey, time to buy office buildings," you call me. I'm in. I'm in when Gary says that he's doing it. I'm in. That's the moment I'm in
It
with.
may be a while, but
Yeah,
yes,
maybe a while,
I,
but when it happens, I'm there.
I'm waiting for someone to come up with the magic formula to convert them to residential. It's one of those things that sort of the holy grail out there. We've got all this excess office space that no one knows what to do with, and a shortage of housing, but it's really, unfortunately, very hard to do in most
It
instances.
is, and it's that I think we have not at all uh, spent any time with the real implications of people never going back to the office again, and how many. I'm in downtown San Francisco, and how many of the neighboring buildings are paid for but unoccupied,
Yeah,
and that still has to. There's a lot to shake out there still.
there is. There is.
Let's do one last set. Let's talk about, we talked a little bit about recession, but let's talk about your forecast. And I don't know if Roofstock has, official forecasts about what you think's happening with rates, recession, inflation for the year.
Yeah.
What do you think happens next there?
Yeah. So this would be Gary Beasley's thoughts, not Roofstock's thoughts. We don't have official thoughts on this. My own personal view, and Mike, I think I might have shared a LinkedIn post that I did, or you might have seen it on CPI in general. And if you look at the way CPI is calculated, it's a simple sum of the prior 12 months. You take the 12 monthly numbers, you add them together, that's the annual CPI. So if you have zero point 0.5 for 12 months in a row, you add it up, it's 6%, right? What's you've seen rates, CPI come down for a few months now. What interestingly, when you look over the next 4 months, 3 of the highest months of inflation we've had in this cycle, all over 1%, 1% or greater, are dropping out of the calculation. And we're going to be replacing those with some new ones. And so I did some forecasts in that post. I think we're going to see rates, the CPI, go from, say, 6% where it is today to say the 4% range, just the way the math works, because it's going to be replaced by 0.3, 0.4, maybe even 0.5, and you're getting rid of a 1.0 or 1.2. So what's that mean? Who cares? Well, the Fed cares, and a lot of people care when CPI starts to show a downward trend, and you layer on the impact of the banking crisis, which, the best I can tell, these regional and local banks have really squeezed their lending already. They're not making the loans. So again, real problem with the commercial refi, because none of these local banks and regional banks are going to be participating in those refis. So it's another 50 basis points equivalent, I think, of like rate increases. So I think Chairman Powell will be able to look to this CPI declining clearly, weakness coming out of the bank failures, and I think we're starting to see a little bit of moderation in the labor market. All these things to me indicate that there's going to be license for the Fed to stop raising soon. Maybe they have one more 25% or 25 basis point raise, I think. And then I think they're probably done. And then maybe by the end of the year, depending on what's going on with the economy, if we're more worried about recession than inflation, maybe we start cutting. So that would be, I think that's not impossible. I don't see continued raises being meaningful from this point. I think that would be too risky. I don't see cuts coming tomorrow, but I do think by year end that's quite possible. What that means is I think we're nearing probably peak mortgage rates, and I think we'll see rates start to come down. And I think once the market sort of feels like the Fed's cutting, I think we're going to see. I think we could be in a very different place in a year or two for sure in terms of rates. What does that mean? Does it mean we're not going to have a recession? No. I think a recession's probably likely in the back half of the year, but how that manifests itself in terms of the housing market. We've had recessions before where real estate has not been as directly impacted. So I think I think real estate is going to do okay. Residential is going to do okay over this cycle. In particular, if I'm right about rates, which, by the way, I could be totally wrong. But I try to have an informed view based on everything that I read, and that's the best view that I can have. There's certainly scenarios where that's not going to be the case, and there are a lot of exogenous factors that you just sort of can't. What's going on with war in Ukraine and supply chain, and there's a lot of stuff that can influence it. But holding all that other stuff constant, that's sort of how I think about it, which is generally, I think, pretty good for housing.
That's really appreciate that take. One of the other elements of the CPI that is worth watching, I think, is that the rent, the housing part of CPI is lagging. And it has maybe 9 to 12 months old data in there in the current CPI. And we're at the tail end of when things were really rising last year. And so that
great point.
Those are even going to go. So it could accelerate the downtrend of CPI later in the year.
Great point. I agree with you.
Well, Gary, this has been really, really terrific. I could keep going for a long time, but I really appreciate your views. I appreciate the work that the Roofstock's doing, and thank you for taking the time with us today. Real quick, I know you write stuff on LinkedIn. Is that the best place for people to follow you?
Yeah, probably. Yeah.
Great. And of course, go to Roofstock. If you don't know Roofstock, go to Roofstock. And especially for real estate investors, it's a really tremendous, really fascinating. And I remember you told the story about being on a plane, sitting next to a guy and watching him invest in real estate next to you, sitting on the plane while you talked to him and told him about the business.
And I can't tell you what his wife said when he landed and he texted. It cannot be repeated in a recorded format, but yeah.
But whatever it was, 5-6 years later, that was a good deal. That was a great deal.
It was a house in Atlanta that he bought for $150,000, and he thought it was the down payment when he was looking over my shoulder. And I said, "No, man, that's the whole price." He said, "Oh my God, I could buy a house for $150,000." And it was a beautiful 2-story brick house in Atlanta. This was a number of years ago. That house is probably $250,000 today. But he and his wife have been trying to buy a house here in the Bay Area, and it was like $600,000 for any sort of rental property. He says, "I'm going to buy 4 of these. She's going to be so happy."
Yeah, and that's the magic. That's really, really terrific. What a great story. Okay, Gary, thank you so much, everybody. This is the Top of Mind podcast. You know where to find us at altosresearch.com. I'm Mike Simonsen. Thank you so much. We'll be back in a week or two. Thanks for listening to Top of Mind. If you enjoyed the show, I'd really appreciate leaving a nice review on your favorite podcast app. That helps other people find us as well. Be sure to subscribe so you don't miss future episodes. See you soon.